Welcome. Today we are going to change how you look at your savings. Instead of seeing your money as passive cash sitting in the dark, I want you to picture it as an active, capable workforce. In this scenario, you are the CEO of your own wealth. Every single dollar, pound, or euro you save is a newly hired employee waiting in the lobby for you to give them a job assignment. The default approach for most of us is to leave those workers completely idle. We stuff them under a mattress or lock them in a basic checking account. When workers have nothing to do, they get lazy, and over time, they lose their strength. This 3D stack represents your idle cash. Notice this dial labeled inflation grinding away at the top. Inflation is the rising cost of everyday goods. If your living costs go up by 10% this year, but your idle cash only earns a 9% return, your stack is actually shrinking. You are losing purchasing power. Now watch what happens when we project this out. Over a 20-year timeline, the top path shows that idle cash quietly disappearing. But if you give those workers a job, represented by the bottom path, they multiply into a massive tower. Investing is a mandatory defensive move for anyone who saves money. You have to deploy your workforce simply to protect the purchasing power of your savings and afford your future life goals. To build a successful company, a CEO organizes employees into specialized departments. Let's meet your first department, fixed income. Think of them as your reliable accountants. This diagram shows how fixed income works. You loan your money to a bank or a government. In exchange, they shake your hand and promise to pay you a specific interest rate. It provides a steady, predictable drip of income, and your original money is generally very safe. Accountants provide stability, but they won't grow your company very fast. For that, you need Department 2, equities. This is your ambitious sales team. Equities, or stocks, mean taking your money and buying a tiny fraction of ownership in a real, publicly listed company on a major stock exchange. This chart shows how equities perform. The line is bumpy, but it trends sharply upward. Those turning gears represent real businesses, building products and generating real profits, which they eventually share with you through capital growth and dividends. The trade-off here is volatility. There are no capital guarantees in this department. If the companies you own struggle, the value of your workers will drop. A smart CEO knows they need both. You rely on the fixed income accountants to keep the lights on during tough times, and you unleash the equity sales team to drive your massive long-term growth. Department 3 is real estate. These workers are the heavy infrastructure of your company. Buying physical property allows you to collect rent and benefit as the land gains value. But physical property requires a massive pile of cash just to get started. You have to manage all repairs yourself, and you can't sell a building in 5 minutes if you suddenly need cash. This is where real estate investment trusts, or REITs, come in. As this animation shows, REITs take a massive commercial property and chop it into tiny, affordable puzzle pieces. You can buy and sell these pieces instantly, collecting real estate income without ever fixing a leaky roof. Finally, we have Department 4, Commodities and Bullion. These workers serve as your company's security guards. Bullion primarily means physical precious metals like gold and silver. They possess built-in, tangible value that does not rely on a bank's promise or a government's printing press. Look at this split-screen diagram. When unpredictable economic storms hit and stock markets crash on the left, capital tends to flee towards safety. The gold on the right stands firm, acting as a financial shield because its value doesn't depend on a bank or a government staying in business to pay you back. While real estate lays down a heavy foundation for your future, your bullion security guards ensure that your company survives the absolute worst economic disasters. You have your 4 departments. Now, as the CEO, how do you decide where to deploy your workers? This scale shows a fundamental principle you will encounter everywhere. Risk and return are tethered together. Notice how they move in lockstep. You simply cannot achieve a high return without accepting a higher level of risk. How you divide your workforce among the different departments is called your asset allocation. The correct mix depends entirely on your age and your personal stomach for risk. This pie chart illustrates an aggressive setup for a young professional. They send 70% of their workers to equity, 20% to bullion, and 10% to fixed income. Watch the chart shift as a worker nears retirement. Needing reliable cash, they completely reorganize the company. Now, 80% move into fixed income, leaving only small groups in equity and bullion. Spreading your workers out like this is called diversification. By never putting all your employees in one department, a bad year in real estate or stocks won't bankrupt your entire operation. Your ultimate advantage in all of this is patience. When your deployed workers earn money, those earnings become brand new workers. Earning interest on top of interest over decades creates a compounding effect, rolling down a long slope and gathering massive financial weight over time. To beat the silent drain of inflation, your money cannot sit idle. Build a balanced workforce, give them specific jobs, and let them work relentlessly for your future.